Morning, everyone. Welcome to MPC Markets Pre-Market Pulse or Morning Call, 1st of July, start of a brand new financial year for the Australian market. Overnight, the headline is stocks eke out a small gain to close the quarter at yet another record. As we can see here in the image, the Bulls have won again. And who would have thought at around about April the 10th that we'd be back up here at record highs. An unprecedented rally over the last 80 to 90 days. Out of bear market territory back to record highs. Never been seen in history, particularly a rally or this sharp and this quick out of a bear market. Has actually probably beaten the previous record by at least 100, 150 days. COVID would be the only time that's even remotely comparable, and it was at half the pace overall. So, yeah, good. Fears are obviously keep being subdued. Everyone seems to think that everything's just going to pan out. Global trade wars are receding. The bulls or the investors out there, their optimism is just buoyed by, they're grabbing onto all the optimistic headlines here at the moment and largely ignoring any of the negative ones. So basically, there was a little bit of optimism around those trade deals on the back of Canada conceding on the digital tax. From a personal standpoint, I think that's why government debt is so bad globally, is because these companies are essentially dodging tax in a very clever way by funneling most of their profits via, licensing fees back to tax havens. And you can see a very big correlation between the amount of cash that the Mag 7 have and the cash pile that they're sitting on, which is, absolutely just running towards $1 trillion compared to where the government debt's going because they're not pulling in those taxes. We're also looking at China as well. There wasn't anything announced necessarily, and all the announcements have been from the US side. I think it seems to be Trump trying to get on top of it and give as much optimism as humanly possible. So, whether that pans out or not, we'll only know next week on the 9th when these July 9 deadlines start to come through, bearing in mind there is a long weekend in the States this weekend for the 4th of July. They did advance that one big, beautiful bill for Trump overnight, which is not very surprising. Senators and, House representatives love going away for their holidays. It's one thing that is very reliable in history. When there's been a deadline leading into a long weekend, deal always gets done. So yeah, we've essentially seen that advance at least. So there shouldn't be any more. There shouldn't be any more worry about that until they come back. And I mean, look, this Congressional Budget Office is essentially going to add $3.3 trillion to the deficit over the next decade, which is obviously at $37 trillion. Heading definitely in the wrong direction. It took a couple of hundred years to get to a trillion, and then we've managed to spiral out of control, particularly over the last sort of decade to 2 decades since the GFC. So essentially, outside of that, there's not really a lot going on. We saw obviously Nikkei continue to rally. The US indexes continue to rally. Up nearly 4% for the week. Aussie market had a decent little, a decent little sort of gain yesterday. I would expect that to be slightly subdued now as we come into the financial year. Fund managers would have been window dressing, and by window dressing I mean propping up their holdings into the end of the financial year. So then they obviously would get, a result for the financial year that they can then go and market to clients for the next 12 months. And they've got 12 months to deal with any of the stuff that is obviously unrealized losses, etc. So don't really expect there to be too much action for the rest of the week, albeit that, something may come out of left field. But given what's happened over the last couple of weeks, couple of months, there seems to be very little that can rattle this market. So we did have gains despite, Amazon, Tesla and Google all being down slightly. Apple was up a small amount that wasn't really on the back of anything in particular. I think there is a massive risk in Apple in the long term. I think they're one major advancement in technology in the smartphone arena from having very big troubles overall. But they are sitting on an enormous pile of cash, and they have made the most of their first, their unique advantage when they came out with the iPhone back in 2007. So still liking Tesla here at the moment, still a little bit of noise. We'll probably have a look at that around about earnings time, which I think is around about 40, 50 days time. Meta as well, they've recruited some more AI talent from OpenAI, and that is something that Sam Altman has been complaining about. But considering he started OpenAI as open source, which was supposed to be for the people and not IPO, I don't think he can complain about capitalism biting him in the bum. So the banks have been very, very buoyant over the last few weeks, really, and underpinning this recovery. Oracle last night did a multi-billion-dollar cloud deal. And in other corporate news, we had Robinhood expanding into crypto offerings. So Robinhood's one of the biggest brokers and online platforms for share trading in the States. So on the commodity front, gold's down for the week, but it's managed to eke out a bit of a gain. Platinum's still hanging in there and going quite well. Copper took a little bit of a breather, but still up about 3 or 4% for the week. We saw lithium also take a little bit of a breather. Coal rebounded. Look, there's no real patterns here in this. The big pattern I think we spoke about yesterday is the US dollar is heading lower. The dollar index down at 96 now. So the dollar index is a basket of global currencies against the dollar. So it's not just a single currency comparison. It's down at levels we haven't seen in in a number of years. That's probably fair enough, and that's probably what's helping buoy the US stock market. It means that effectively, with the highest level of foreign investment in the US stock market at the moment, the US dollar being weaker means that for foreign investors, like a lot of Australian super funds, for instance, you're effectively getting more bang for your buck to be in really good companies that are obviously taking advantage of those those loopholes in the tax system, etc. That I was talking about before. So we are heading into obviously payrolls on this Thursday. It normally is a Friday, and I think we've got very little in terms of any economic news. We've got a few central bank speakers. Governor Ueda from Japan. That's a bit of a tricky situation there, but they generally do toe the line, the Japanese. Bank of England's Bailey speaks. He's the governor. They're usually fairly stiff upper lip and very, very much, don't beat around the bush and try to give the sunny side of things. And then we've got ISM manufacturing tonight in the States, which could be quite telling given the tariff effects. And then Fed Powell speaks tonight. Fed Powell has basically said there really is no reason to be cutting rates. The market generally, all they hear is cutting rates. So I don't expect that to change. He would have to be very hawkish, and by hawkish I mean leaning towards not cutting rates rather than being dovish, which means cutting rates. So the market at the moment just hears what it wants to hear. So in all honesty, I think you've got to run with it. As much as there is a lot of risk out there at the moment, I don't see anything derailing this. We've had a lot thrown at this market over the last few months. But traditionally, July is a pretty seasonally good month. Usually, on average, the S&P gains about 1.5%. But it is usually also a very, very good time to take some risk off the table. Possibly, I would say, towards the end of the month. But I think for the next 2 weeks, I think you can probably run with this market. We'll continue to eke out small gains on a pretty regular basis, and until we start to see earnings come through, which will be in a couple of weeks in the States, starting with the banks. Today for the ASX, don't expect a hell of a lot. We tend to be more warriors than the US, who tend to just plough through any pessimism. I would expect us probably to drift off after the window dressing yesterday. and I dare say the focus is going to increasingly be, for the Australian market, be on the China economic recovery and whether they can pull that off. But not much to do, I wouldn't expect, for the next few days. We'll probably start to heat back up next week. And so, stay safe out there. As I said, this is probably not a bad time over the next 2 weeks, possibly between like the third week of the month, to be taking some risk off. But until then, I think there'll be some good opportunities out there in the market.